Hello everyone, I'm Dr. Sunita Ravi. Today I have come out with another question on marginal costing and profit planning. So let's understand the question. The information is given for two companies X Limited and Y Limited. They sell the same type of product in the same market and sale is given variable cost, fixed cost and profit, and based on this information first we calculate the break even point, then we have to state the effect of the profits of the company in condition of increasing demand and falling demand, and calculate the sales volume to earn a profit of 50,000. So one by one we do this question. First we calculate break even point. So there are two companies, one is X Limited and second one Y Limited. First we have to calculate break even point. Break even point is equal to fixed cost upon PV ratio. So we have to calculate PV ratio. PV ratio based on the information given in the question, sales and variable cost, we know that, so we can apply that formula: sales minus variable cost upon sales into 100. So we calculate for X and Y. Here sale value is same for both the company, and in case X variable cost is 3,20,000, so we write it here 4 lakh minus 3,20,000 upon 4 lakh into 100, that is equal to 20%. Same we have to calculate for Y Limited. Sale is same and variable cost is 2,80,000, so we write it here 4 lakh minus 2,80,000 upon 4 lakh into 100, that is equal to 30%. This is our first answer, PV ratio. Now in order to calculate this break-even point, fixed cost upon PV ratio, fixed cost is given for X Limited, it is 40,000 and Y Limited 80,000. So here we have to put that value, that is equal to 40,000 upon PV ratio of this particular company is 20%. So we write it here 20%, that is equal to 2 lakh. And for Y Limited, fixed cost is 80,000 and PV ratio of Y Limited is equal to 30%, so we write it here 30%. So the answer is 2,66,667. Next we have to state what shall be the effect of the profits of the company in case of increasing demand and falling demand. Demand is based on our sales, so we have to increase or decrease. If any percentage units are not given, so we can assume, so B part X Limited, Y Limited, first we consider increasing in demand. So already existing sale is equal to 4 lakh. So we assume increase 10%, that is equal to 40,000. Now the sale is equal to 4,40,000. Now according to the statement we have to state the profit of the company. So profit is equal to sales into PV ratio minus fixed cost. So here sale is equal to 4,40,000 multiplied by PV ratio of this particular company is 20%. So we write it here 20 upon 100, minus fixed cost of this company is equal to 40,000. That is equal to 48,000, and here in case of Y Limited 4,40,000 multiplied by PV ratio of this particular company is 30%, so we write it here 30 upon 100 minus fixed cost of this company is equal to 80,000, so we write it here minus 80,000, that is equal to 52,000. Now we can make a conclusion that Y Limited is more profitable in case of increasing in demand, because the profit of Y Limited is more as compared to X Limited. The same we have to calculate for decreasing in demand. So we write it here falling in demand. So the given sale is equal to 4 lakh. Now we assume decrease of 10%, that is equal to 40,000. So now the sale is equal to 3,60,000. Now profit is equal to sales into PV ratio minus fixed cost to company X Limited and Y Limited. So here we have to write sale is equal to 3,60,000 multiplied by PV ratio is equal to 20 upon 100 minus fixed cost is 40,000, that is equal to 32,000, and in case of Y Limited 3,60,000 into PV ratio of this particular company is 30 upon 100 minus 80,000, that is equal to 28,000. So we can conclude that profit of X Limited is more as compared to Y Limited in case of falling in demand. So this company is more profitable. And the last and final, we have to calculate the sales volume at which each business will earn 50,000 profit, because this is the desired profit is given. We have to calculate the sales. Now we apply the formula. See, sales is equal to sales volume is equal to fixed cost plus desired profit upon PV ratio. So for this company fixed cost is given 40,000, desired profit is given in the question, it is written there 50,000, so we write it here 50,000 upon PV ratio of this particular company is 20%, that is equal to 4,50,000. Same we calculate it for Y Limited, that is equal to fixed cost is 80,000 plus desired profit is same 50,000 upon PV ratio this particular company is 30%, that is equal to 4,33,333. Question is over. Thanks for watching the video.